Thank you for watching this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps financial advisors, money managers, and individual investors understand the trend direction and the current level of risk in the stock market, allowing you to make better asset allocation, investment, risk management, and trading decisions, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, September 4th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. For the week, we were down 2.31% on the S&P 500, and we closed at 3426.96. The first chart that we're going to look at is a one-year weekly chart of the S&P 500, so each candlestick does represent 1 week of trading. The blue line is set at 3350. So what we can see here is during the week, we pulled back to the 3350 level, which there is some support there. That is why we bounced off of that. You can see that it acted as an overhead resistance point back at the beginning of August, and then as a support level during the first week or so of August. And back in the first part of this year, we traded right up to that level at the end of January, beginning of February, and then had 1 week where we closed above that 3350 level, of course, before we rolled over and rolled down. So the fact that we pulled back to the 3350 level may have relieved enough pressure on this market to allow us to go higher over the next couple of weeks. But guys, you're going to see in a few of the other charts I have to share with you just how overextended this market still is even after this week's pullback. The next chart that we're going to look at is a 5-year weekly chart of the S&P 500 with this 3350 line still intact. So basically all I did was pull this chart out for 5 years now because I wanted you to see just how extended above the 40-week moving average, this orange line, we still are even after this week's pullback. So guys, look at over the last 5 years. Anytime you run above the 40-week moving average to any degree, you generally at some point are going to pull back to it. You can have longer periods of time where you run above that 40-week moving average, like during 2017. We didn't touch it once. But the further you get above the 40-week moving average, the more likely you are to pull back to it, as we see here, as we see here, as we see here, here, and here. So, it's just inevitable, right, that we're going to pull back to this 40-week moving average at some point in the future. And the fact that we're so far extended above it, to me, makes it much more likely that we're going to pull back to this 40-week moving average, or at least towards it, sooner rather than later. Yes, we had a little bit of a pullback this week, but it was pretty minor, really, all things considered, relative to how overextended this market still is. So was it enough to bleed off a little pressure off this market, allowing this market to continue to rally for another few weeks? It's totally possible. But it's also possible that this was just the beginning of what could turn into a more serious downturn. And also keep in mind that we are in the middle now of the worst 3 months of the year. And September, technically, over the course of many years, tends to be the worst month of the year. We're also just a couple of months out from a presidential election, so that adds uncertainty to the markets. There's no near-term catalyst for upside that I can see. We've already had the stock splits in Apple and Tesla, which technically does nothing to the stock, but people get excited about it, and that causes a short-term catalyst, especially when you're talking about larger stocks like Tesla and Apple. So that added a little bit more euphoria here in the short term to the markets, but those things are now behind us. We're beyond earnings season, so there isn't any short-term catalysts that I can see that would allow this market or cause this market to continue to rally at the pace that it has been rallying over the last few months. The next chart that we're going to look at is a year-to-date daily chart of the S&P 500, and this orange line is the 200-day moving average. which of course is equivalent to the 40-week that we've just been looking at. And here, this blue line is the trend line that we had in place that started at the end of June. And you can see that we've pulled back to this trend line several times, but today we closed beneath the trend line. So today, Friday, September 4th, we closed beneath this trend line for the first time in over 2 months. So again, we could jump right back above this next week. It's completely possible. But the fact that we had about 10 weeks where we were above this trend line and we're now trading below it tells us that we need to be a little cautious here. And the S&P 500, of course, wasn't the only part of the stock market that sold off this week. The DIA that tracks the Dow Jones Industrial 30 was off 1.74% for the week. The IWM, which tracks the Russell 2000 Small Cap Index, down 274. The MDY, which is the ETF that tracks the S&P 400 Mid Cap Index, was down 253. And the Triple Qs that tracks the NASDAQ 100, down over 3% for the week. Now let's take a look at a 5-year weekly chart of the Triple Qs, the NASDAQ 100. And again, we can see the orange line is the 40-week moving average. And look at how far extended above the 40-week moving average we are at this time on the Triple Qs. Again, down over 3% for the week. And we've got a huge gap here, guys. That's over 20%. We are still trading more than 20% above the 40-week moving average on the Triple Qs, even after the pullback this week. And just like with the S&P 500, you can see that the NASDAQ 100, the Triple Qs, has a tendency to pull back to its 40-week moving average on a fairly regular basis. So the fact that we are so far above the 40-week moving average right now on the Triple Qs, in addition to the fact that we're seasonally in one of the worst parts of the year. Again, September traditionally, not always, but traditionally is one of the worst months of the year. The presidential election, the fact that earnings are going to be 20 to 30% lower this year than they were last year. Guys, there's still so much uncertainty out here that it would be, I believe, a little naive and perhaps unrealistic of us to believe that this market is likely or guaranteed at least to continue to rally at the pace that it has. It's completely possible, I suppose, but statistical probabilities tell us that when we're this overextended on so many stocks and so many major indexes, that we're very likely to have a continued pullback, at least in the near term. So it may make some sense to be cautious over the next few weeks. Before we go any further, let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market. And I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it. And most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and then we know that we hit the all-time high on February 19th at 3386.15. That is the closing high so far on the S&P 500. And then we had this intraday reversal on Thursday, which I talked about in my Simple Market Signals newsletter, which of course is how I disseminate the signals. And then we closed lower on Friday again. And so what we can see here is, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over, and that that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, okay? And it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October, all right? So that thing had been positive for, 5-6 months, and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the Simple Market Signals model, there are 3 powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.